In 2008, a financial instrument that almost no ordinary person had ever heard of came within days of collapsing the global economy. Regulators called it dangerous. Economists called it opaque. A congressional report called it one of the primary causes of the worst financial crisis since the Great Depression. By 2024, it was a $22 trillion market. That instrument is called a Collateralized Debt Obligation, a CDO. And the story of how it survived its own catastrophe and came back larger tells you something important about how financial systems actually learn from their mistakes. Spoiler, they mostly don't. To understand what a CDO is, you need to start with a simpler question. What do you do when you have a lot of debt, and you need to turn it into something people want to buy? Because debt, on its own, is not particularly attractive. If someone owes you money, that's useful. But you can't easily trade it. You can't sell a fraction of it to a pension fund in Norway. You can't package it alongside 500 other debts and price the whole thing like a stock. At least, not without some financial engineering. This is where the CDO enters. The basic idea is straightforward. Take a large pool of loans, mortgages, car loans, corporate debt, credit card balances, and bundle them together into a single structure. Then slice that structure into layers, called tranches, each with a different level of risk and a different rate of return. The bottom tranche absorbs losses first. The top tranche only takes a hit if almost everything in the pool defaults simultaneously. The top tranche gets rated AAA, the same rating as U.S. government debt, the safest possible designation. And then you sell those tranches to investors all over the world. Pension funds buy the safe top layer. Hedge funds buy the riskier bottom. Everyone gets yield. Everyone gets diversification. The bank that originated the loans gets them off its balance sheet and can go make more. The whole machine runs beautifully. Until it doesn't. The problem in 2008 wasn't really the CDO structure itself. It was what got put inside it. Through the early 2000s, mortgage originators across the United States were issuing home loans to borrowers who, in many cases, could not remotely afford them. No income verification. No down payment. Adjustable rates that would reset sharply upward after 2 years. These loans were called subprime, and they were being bundled into CDOs at industrial scale, repackaged, resliced, re-rated, and sold globally as investment-grade securities. The ratings agencies, whose entire job was to assess the risk of these instruments, gave enormous percentages of these pools AAA ratings. The math they used assumed that housing prices would never fall simultaneously across the entire country. It was an assumption so catastrophically wrong that it's almost difficult to say with a straight face. By 2007, U.S. housing prices began to fall. Not everywhere at once, then everywhere at once. Defaults spiked. The bottom tranches of CDOs were wiped out. Then the middle tranches. Then instruments that were supposedly protected by layers of other instruments, CDOs made of other CDOs, which Wall Street, with admirable creativity, had named CDO squareds, began failing too. Institutions that held these securities on their books suddenly couldn't value them, couldn't sell them, and couldn't be sure what they were actually worth. The trust that underpins the entire financial system evaporated in weeks. The instrument that was supposed to distribute risk and make the system more stable had instead concentrated risk invisibly, in places no one had mapped, in quantities no one had fully counted. Here is where the story gets strange. After 2008, there were investigations, reports, hearings, fines. The word CDO became toxic. Documentaries were made. Books were written. A film starring Ryan Gosling and Brad Pitt explained the whole thing to mainstream audiences using a Jenga tower and a bubble bath. The financial world, apparently, had learned its lesson. And then, quietly, it started again. The new version was rebranded. Instead of CDOs backed by subprime mortgages, the market pivoted to CLOs, collateralized loan obligations, backed by leveraged corporate loans. Loans made to companies that already carried significant debt. The structure was nearly identical. The tranching was nearly identical. The AAA ratings at the top were nearly identical. By 2023, the global CLO market had surpassed $1 trillion in the United States alone. The broader structured credit market, of which CDOs and CLOs are the most visible parts, had grown to a scale that dwarfed its pre-crisis size. The instrument didn't disappear. It rebranded, found new underlying assets, and grew back larger than before. Now, there are serious analysts who will tell you that CLOs are genuinely safer than the pre-2008 CDOs. The underlying loans are corporate, not subprime residential. Default correlation is different. The structures are more transparent. Regulatory oversight is more rigorous. These are not trivial points. The comparison isn't perfect. But there's a pattern here that goes beyond the specific instrument. Every financial crisis produces a new regulatory framework designed to prevent that exact crisis from happening again. And every new financial structure is built just differently enough to fall outside that framework, while being just similar enough to generate the same yields that made the old structure so attractive in the first place. The problem was never really the CDO. The problem was the incentive to turn risk into yield, complexity into ratings, and opacity into confidence. Those incentives didn't disappear in 2008. They adapted. The instrument that caused the crisis became more popular after it, not because people forgot what happened. Most of them knew exactly what happened. They just believed, for a variety of reasons that each made sense individually, that this time the structure was sound. Which is, almost word for word, what the people who built the last one believed too. The question worth sitting with isn't whether CDOs and CLOs are dangerous. It's simpler and more uncomfortable than that. If the lesson of 2008 was this visible, this documented, this cinematic, and the market still grew back to $22 trillion, what exactly would it take for the lesson to actually stick?